Welcome back to the deep dive. Our goal is, to hand you the critical insights from the research you need.
Straight through the noise.
Exactly.
Yeah.
And today we're plunging into prediction markets. This is a sector that has quickly graduated from being this niche Web3 fascination to, well, a major piece of event-driven financial infrastructure.
The transformation is pretty remarkable. If you just look at the raw data, the cumulative trading volume, it recently sailed past $13 billion.
Wow.
And critically, the growth isn't just, steady, it's explosive. In the last week of October 2025 alone, sources show we hit a weekly all-time high of $2.3 billion.
2.3 billion in a single week.
Yeah. At that scale, we are no longer talking about simple side bets. This is, a rapidly maturing global financial layer.
That volume surge is definitely the headline. But our mission today is to really unpack the whole ecosystem. We need to understand what's driving this growth, this ongoing regulatory battle between the centralized and decentralized platforms.
And the inefficiencies.
And most importantly, why there are still these strange, really costly pricing inefficiencies baked right into these markets. It's a phenomenon that, even strategic investment from someone like CZ couldn't prevent.
It's the essential puzzle piece of this whole deep dive, I think.
Okay, so let's start at the beginning. For anyone just catching up, what exactly is a prediction market? How does this mechanism actually turn, collective belief into a price?
At its core, a prediction market just harnesses collective intelligence. Participants buy or sell shares in the probability of a future event happening.
Right.
The mechanics are pretty simple. Contracts are priced between $0 and $1, and that price instantly becomes the market-implied probability.
It's interesting how simple that $0 to $1 mechanism is. So what's the immediate value proposition there over, say, just a traditional poll?
The value comes from the fact that people have skin in the game. They're financially staked, in their opinion. So unlike a static poll, this is real-time, event-driven price discovery. And the evidence suggests this method. It often produces a more accurate signal.
Like with the 2024 U.S. election, right?
Yeah.
Polymarket was getting a lot of attention then.
Exactly. It became a really high-profile reference point, often providing more immediate and, frankly, more accurate odds than the traditional survey results were showing.
The accuracy is compelling, for sure.
Yeah.
But let's circle back to the scale. The sheer size of this 2025 boom. That feels like the real story here.
It absolutely is. Total trading volume exceeded $27.9 billion just between January and October of 2025.
That's incredible.
It really shows it's crossing the chasm, so to speak. It's moving into institutional and mainstream acceptance.
We're seeing traditional finance looking in, but also, outright adoption.
Right.
Sports firms like Fanatics launched a marketplace in 24 U.S. states, and then you have major crypto infrastructure, Coinbase, MetaMask. They're building these features right into their products.
It's becoming expected functionality, not just some novelty feature.
Yeah. And that institutional backing, it really got a shot in the arm from CZ's investment firm, Wyzee Labs. Their strategy was key.
How so?
They backed two platforms that were specifically designed to solve major problems in the space, and both were running on BNB chain.
Opinion and Predict.fun. So what was the impact of that support?
Well, Opinion saw this astonishing, just immediate surge. It launched in October 2025, and it hit nearly $1.5 billion in weekly trading volume within 4 weeks.
4 weeks. So it captured, 40% of the market share?
In that short period, yes, about 40%. It briefly eclipsed players who'd been around for ages. That early Wyzee Labs support, it clearly provided the liquidity and the visibility they needed.
And Predict.fun, that one addresses a core structural weakness of pretty much all prediction markets, right? Capital inefficiency.
Precisely. Predict.fun's big innovation is that the capital you lock into a prediction, it continues to generate yield until the event is over.
That's a huge deal. It is. It solves that problem of your capital just sitting idle, sometimes for months. By generating yield, they attract a broader, maybe more conservative class of participant who wouldn't otherwise lock up their funds.
So this explosive volume, this new infrastructure, it really highlights the dual nature of the market. Maybe we should pivot a bit and look at how that volume is split between The regulated and decentralized players.
Yeah, because that split really dictates everything: global access, compliance, all of it.
So what does that spectrum look like?
On one side, you have the decentralized markets. Polymarket is the classic example here.
Right.
It's non-custodial, blockchain-based, uses a hybrid order book, and it relies on a decentralized oracle like UMA protocol to resolve things.
Which makes it globally accessible.
Globally accessible, but it often has to exclude the highly regulated U.S. market.
And on the other end, you have the fully regulated markets.
Yeah.
Kalshi is the one that comes to mind.
Kalshi is the classic, yeah. A fully CFTC-regulated designated contract market centralized order book. But the sources also focus a lot on Crypto.com's Derivatives North America, or CDNA.
CDNA. What makes them stand out?
They offer these event contracts as a regulated derivatives product, and that provides crucial legal clarity for U.S. participants.
And tax advantages, I saw.
A particularly notable one: losses from trading these derivatives might be deductible against ordinary income up to $3,000 a year. That's a huge difference compared to just traditional gambling losses.
So that immediately changes the perception. It classifies these as, serious financial derivatives, not just online betting.
It does, but, and this is where we get to the core puzzle, if these markets are so good at aggregating information, why does the data show that some people are, well, routinely making financially poor decisions?
Let's dig into that Kalshi data.
Okay.
They use a quote-driven system, right? So you have makers who post limit orders and takers who accept market orders for immediate execution.
That's right. And what the data shows about those two groups is fascinating. It reveals the systemic flaw that they call the favorite long shot bias.
Which we've seen in sports betting for years.
Exactly. It's well documented there, but now we have empirical proof of it in financial prediction markets. Low price contracts, the long shots, they just win significantly less often than their market price suggests.
The market consistently overprices them.
Consistently.
So what are the financial consequences for the people buying those long shots?
They're brutal. I mean, contracts priced at 10 cents or less show average loss rates of over 60% for the people who buy them.
60%. Just think about the emotional cost baked into a number like that.
It's huge.
Is this bias just, the financial cost of human impatience? Or is it the price of buying a lottery ticket? That thrill of a low probability, high payout event?
The data suggests it's a very high price for impatience. When you break down the results by user type, the takers, the ones who want that immediate execution, they have average returns of negative 31.46% post-fee.
Minus 31%.
But the makers, who are more strategic, more patient, they do much better. Their average returns are negative 11.99%.
So a 20 percentage point difference.
Yeah.
That basically positions the takers as the source of the market's inefficiency.
They're subsidizing the market. They're willingly accepting bad prices on cheap contracts.
And the data backs this up for the makers too, right?
It does. Makers who buy high-priced contracts, so above 50 cents, they actually earn small, statistically significant positive returns, around 1.9% post-commission.
So the system is just rigged to reward patience and penalize that over-optimistic taker.
It's all driven by behavioral bias, a powerful insight into human nature, really.
It is. Okay, let's look forward. What innovations are coming to solve some of these infrastructure and efficiency problems?
Well, capital efficiency is still the main focus. Predict.fun offered yield, which was a great start. But a project called Gondor is building the next level, infrastructure that allows for lending against your open prediction positions.
Oh, that's interesting. So you free up liquidity.
Exactly. You don't just earn yield. You can deploy that capital into new markets while still keeping your exposure to the original bet. That's critical for unlocking truly long-term prediction markets.
We're also seeing this merging of prediction markets with the creator economy. Tell us about Melee markets on Solana.
Yeah, Melee is introducing what they call viral prediction markets. It uses a bonding curve mechanism, kind of like what you see in meme coin launches.
So it rewards early adopters.
It rewards early participants with asymmetrical upside. Yeah. It's designed for, permissionless market creation around social trends, pop culture, and it helps monetize content creators by pulling their audiences into the financial loop.
And maybe the biggest signal of mainstream acceptance is that integration into social media, specifically Truth Predict from TMTG.
Yes. TMTG is launching a prediction market feature on Truth Social. And crucially, they're leveraging the compliant infrastructure from Crypto.com's CDNA.
That's a pivotal moment. You have a major social media platform merging event finance directly into its ecosystem, but doing it through regulated, compliant channels.
It's a huge step.
But the innovation is relentless, and so is the risk, especially in the Web3 space. The Oracle problem still looms over the decentralized platforms.
It really remains the Achilles heel. I mean, decentralized Oracle reliability. Opinion is trying to use AI-driven oracles to resolve complex macro data, which is promising.
But the existing systems.
The existing decentralized systems like UMA protocol, they introduce two massive risks: settlement bottlenecks and manipulation.
How bad are we talking with the bottlenecks?
Dispute resolution in a system like UMA can drag on for 48 to 96 hours. That just kills liquidity.
And the manipulation risk is even worse.
Much worse. Since truth is often dictated by who holds the most tokens, the system becomes plutocratic.
Meaning the wealthiest holders, not the experts, dictate the outcome.
Exactly. The sources documented a $7 million loss back in March 2025 on one platform due to just this kind of Oracle manipulation.
So you're trading the accessibility of decentralization for the security and speed of, well, whoever holds the most tokens. That's a serious trade-off.
It is. And there are two final warning flags to mention. First, we have to scrutinize that rapid volume growth on platforms like Opinion.
You think it might be inflated?
Experts warn that these meteoric spikes might be artificial, not from true organic adoption. So that raises questions about their long-term sustainability.
And the second flag?
Regulatory scrutiny. As these markets attract more retail users outside of compliant frameworks like CDNA and Kalshi, the regulators are only going to pay more attention. That blurry line between a financial derivative and unregulated gambling is exactly where they'll focus.
Okay, so what does this all mean for you listening? Prediction markets, they're no longer nascent. We have this mature, split market.
On one side, highly compliant, institutionally backed systems like CDNA and Kalshi.
And on the other, innovative, high-growth Web3 projects like Opinion, Predict.fun, and Gondor that are all about capital efficiency and viral loops. The battle will be won by whoever can balance compliance, deep liquidity, and technological openness.
And here's the central paradox for you to think about. Prediction markets, they're celebrated for synthesizing information, for reflecting our collective intelligence. Yet the overwhelming data shows that a huge segment of participants, the takers, are consistently making financially irrational decisions. They're paying a steep premium for the chance to be wrong.
So the puzzle isn't just about prediction.
Right. The core challenge for the future isn't just about predicting events, but understanding why our human behavioral biases remain such a persistent and expensive form of market inefficiency.
That's fascinating. So think about that maker-taker dynamic. Are you an impatient taker or a strategic maker?
Wow.
We really encourage you to research the regulatory distinctions between CDNA, Kalshi, and their decentralized counterparts. Thanks for diving deep with us.
We'll catch you next time.